Hello and welcome back to another episode of Accounting 201. I'm your host, Dr. B. Today we're going to be talking about Chapter 10, Liabilities. Current liabilities, installment notes, and contingencies. More specifically in this chapter, we're going to be doing a deep dive on notes payables, the conversion to notes payables, and all that fun stuff in between. So let's get started. When we think of a current liability, we think of something that the business owes to someone else. That's a liability. A liability is when you owe money to someone else. That is a liability. A current liability means we owe that liability within 12 months or less, within 1 year. That's what makes it current. So there are a couple of other elements you need to understand about what makes things current and what makes them a liability. When a company or a bank advances credit, it is making a loan. So for example, if you have a credit card, if you have a payday loan, if you have a short-term loan, if you have a what do they call that? Home equity loan. These are loans made by the bank that you pay back on a regular basis, typically within less than a year. Another one would be a credit card. Most of you have that. A credit card is a loan. You may not think of it that way, but it is. It's a loan. You've been lended credit. When you are lended credit, you must pay that credit back. Therefore, it's a loan. Okay? A lot of people don't think of credit cards as loans, but they are. They're short-term loans, right? The individuals or companies receiving the loan is called a debtor or borrower. The bank lending the money is called a creditor or lender. The debt recorded as a liability. The debt is recorded as a liability by the debtor. So if I am receiving a loan, I record that loan as a liability. Now remember, a liability means we owe the money to someone else, right? That's what makes it a liability. There are two types of liabilities. One is long-term, the other one is current. Long-term liabilities are debts that go beyond 1 year, and current liabilities must be paid back in less than 1 year. Okay, so there are other forms of liabilities that are current. One is called accounts payable. Accounts payable, as you know, is the recording of a purchase of either a service or inventory or something else on account. When the company purchases something on account, we record it to accounts payable. Of course, we debit whatever it is, whether it's inventory or whether it's supplies or some type of other expense. We debit the expense and we credit accounts payable to record the payable. It is a short-term liability, right? That's accounts payable. You all know what accounts payable is. We've been talking about that for the past 8 chapters, right? Another thing that is current is what we call accrued liabilities. Accrued liabilities. And this is a reflection of an obligation to pay current assets in the future. Accrued liabilities. It's kind of like prepaid insurance. We paid it already, but we have not yet incurred it. Okay? Or, that would be a prepaid asset on our side if we paid the insurance, but have yet not incurred it. A liability would be our customer paid us in advance, but we have not yet performed the work. Okay, that's an accrued liability on our end. Yeah. Accrued liabilities are normally recorded at the end of the accounting period and are part of the adjustment process. Most companies' accounts payable and accrued liabilities are the largest portion of current liabilities. And that's pretty standard. Usually, when you look at a company's income balance sheet, if you look at their balance sheet, you'll recognize that accounts payable is typically the largest amount for a current liability for the company. That is because they use it frequently, right? So that's current liability. Now let's talk about the notes payable. A note payable is a loan. A note is a loan. Okay, a note is a simple word for a loan. That's a note. A note. It's not like you're writing your friend a note in class. No, that's not a note. A note is debt. A note is a loan. Okay. Notes may be issued to purchase merchandise or other assets. So a bank writes my company a loan. I use that loan money to then purchase inventory or to purchase machinery or a building or whatever, right? Notes may also be issued to creditors to satisfy an account payable created earlier. So, in other words, I could refinance my earlier note. That's one way of thinking about it. So, when we talk about short term, we know that it's 12 months or less. In most cases, if our company is issuing a notes payable, that means we're converting an accounts payable to a note. The reason why that happens is because sometimes our customers get behind on their accounts payable. And in order for them to get caught up, I will convert their accounts payable into a note payable. Okay? And the same could be done for us, right? If we fall behind on our bill, the company can convert it to a notes payable. The reason why they do that is to encourage us to pay on time and also to satisfy the amount that we owe them. And typically with any type of note or loan, there's an interest rate and a due date and a principal balance, right? Let's look at this example. Let's assume this company issues a 90-day 12% note for $1,000 that was dated on August 1st to one of their customers for an overdue account payable. So to record this entry, what we do is we debit accounts payable to reduce the payable for that customer. And we credit notes payable to increase the notes payable for that customer. The way to think about this entry is we're converting the account payable into a note payable. We're moving it. We're moving the money. We're moving it out of accounts payable and putting it into notes payable. And the way we do that was we debit accounts payable and credit notes payable. And of course, we type in our fancy little memo, right? Issued 90 days, 12% note on account. So eventually, it's got to get paid, right? So let's say they made that loan for us, right? And we're the ones paying it. So when that note matures, meaning it comes due, right? When you hear the word mature, it means it's coming due. The entry to record the payment plus the interest is the following. We debit notes payable, okay, to reduce the notes payable, $1,000. We debit interest expense to increase our interest expense $30. Now you're wondering, Dr. B, how was it $30? Well, we took the face value of $1,000 times 12%, okay, times 90 divided by 360. I can already hear you. Why 90 divided by 360? And remember the order of operations. You got to do division first before you do multiplication, right? So this 90 represents 90 days, okay? 360 represents 360 days in a year. I can already hear you. Dr. B, there's 365 days in a year. I know that. But in a calendar year, there are actually only 360 banking days in a year. Banking days. Because there are 5 bank holidays in a given year. So, what do? First we do 90 divided by 360. Then we do 1,000 times 12%. And then we do whatever that is times 90 divided by 360, which gets us to $30. So remember, order of operations, do division before you do multiplication. So we do all that to get $30. So debit, notes payable, $1,000, face value. Debit, interest expense to represent the interest that we're paying out, $30. And of course, we credit our cash, $1,030. Because so obviously we're paying the interest in cash too, right? So $1,000 plus the $30, $1,030 cash paid out. And as you know, every time that we pay cash out, we credit cash. And the memo says paid principal and interest due on the note. Again, note is a loan. Interest expense is reported in the other expense section on the income statement, which actually shows up below your other expenses. The interest expense account is closed at the end of the year through the accounting cycle. Remember, interest expense is a temporary account. So at the end of the accounting cycle, it gets closed out, just like all of the other temporary accounts on the income statement. Each note transaction affects a debtor, who's the borrower, and a creditor, who's the lender. That makes sense. I'm receiving or sending money to someone, right? So the debtor is the borrower, the creditor is the lender. A company may also borrow money from a bank by issuing a note. And here's how that looks. Let's say we're the company, okay? And we're borrowing money from First National Bank to do whatever it is that we need to do, right? So here's the assumption. On September 19th, our company Iceberg, apparently we sell lettuce, I don't know, borrowed cash from First National Bank by issuing a $4,000 90-day 15% note to the bank. The entity recorded the issuance of the note and the cash proceeds as follows. September 19th, we debit cash to increase our cash, $4,000. We credit notes payable to increase our notes payable, $4,000. And then, of course, the memo issued 90-day 15% note to the bank. On the due date of the note, so here we are 90 days later, on the due date of the note, December 18th.
Professor, I got a question.
Yeah, please go ahead, Lakeisha.
On that last one about the note, is that almost like the example of like a promissory note?
Yes, 100% correct. Absolutely. Yep, great. And I remember you and I had that conversation last week or the week before. Yep. Yes, absolutely. It's a promissory note, but we're also getting the cash at that time. Yeah. So on the due date of the note, our company owes the bank the $4,000 that we borrowed plus interest. The interest is $150. How did we get $150? So just like before, we took 90 days divided by 360 banking days in a year times $4,000 times the 15% to get to 150. So we debit notes payable $4,000 to reduce our notes payable. We debit interest expense $150 to increase our interest expense. And we credit cash $4,150 to reduce our cash. And this represents the paid principal and interest due on the loan or the note. Okay, in some cases, a discounted note may be issued rather than an interest-bearing note. Okay, let's break that down. A discount note has the following characteristics. Number one, the interest rate on the note is called a discount rate. Discount rate. So instead of it calling interest, it's called a discount rate. The amount of interest on the note is called the discount. It's computed by multiplying the discount rate times the face value of the note. Number three, the debtor or the borrower receives the face amount of the note less the discount. We call that the proceeds. And number four, the debtor must repay the face amount of the note on the due date. So the way I want you to think about this is, in our earlier example, we borrowed $4,000 from the bank with a 15% interest rate. Instead of this being an interest rate, if it was a discount, we would not receive $4,000. We would receive $3,850. But we would repay $4,000. Let me explain it. Okay, let's look at the example. On August 10th, the company issues a $20,000 90-day discounted note to the bank. Like you said, Lakeisha, promissory note. Absolutely. The discount rate is 15%, and the amount of the discount is $750. Again, how we get $750? 90 divided by 360 banking days in a year times 20,000 times 15% to get $750. The entry to record the proceeds received by the company is the following. We debit cash, $19,250. Okay. Why $19,250, you might be asking. Remember, the principal amount was $20,000. We were issued a discount, 15%, which is $750. So $20,000 minus $750 equals $19,250. So we debit cash by that amount because that's the actual cash that our company is receiving from the bank. Then we debit our interest expense $750 to increase our interest expense by $750. And then we credit notes payable $20,000 to increase our notes payable by $20,000. And of course, our memo issued 90-day discount note to the bank, 15% discount rate. So 90 days goes by, we now have to pay the bank the note. So on November 8th, we debit notes payable $20,000, and we credit cash $20,000 to reduce our notes payable and to reduce our cash. The reason why it's for the full $20,000 is because, remember, there's 15% interest on that loan. So the bank only gave us $19,250. We recognize the interest expense, and we recognize the face value of the note. We still pay that amount back. $20,000 paid back. Does it make sense? Any questions? We good so far? Okay.
Yes.
Good. All right. Thank you, Bertie. Appreciate it. Okay. Okay. Let's talk a little bit about long-term debt. Long-term, as you know, is greater than 1 year. With a long-term debt, or long-term note, we also call these installment notes. With an installment note or a long-term note, there is a current portion of that long-term debt. Now, as you know, current means 12 months or less. Long-term is more than 12 months. So think of it this way. Let's say you bought a car, okay? You bought a car on a $25,000 note. You have to pay it back in 5 years. That $25,000, 5 years, okay? That first year, that first 12 months, we call that the current portion of the long-term note. So again, the example I gave is you purchase a car on a loan. The loan is for 5 years at $25,000. That first 12 months of that 5-year note is called the current portion of the long-term debt. That's what current portion of long-term debt means. So when you see that on the balance sheet, you're going to see a line item that says current portion of long-term debt under current liabilities. And under long-term liabilities, you'll see notes payable. Right? Okay. And this is done by an installment note, which is a debt that requires the borrower to make equal periodic payments over the life or the term of the note. For example, a car, $25,000, 5 years, equal installments, which is 12 payments per year for those 5 years, right? Works just like a mortgage. Same concept. Installment notes are often used to purchase property, plant, and equipment. A car is equipment, in my opinion. Property is your home. A plant is your building. Property is the land, right? Plant is your home. Equipment is your car. From a personal perspective, obviously. But from a business perspective, property, plant, equipment. Okay, so that's current portion of long-term debt. Now let's talk about other current liabilities, like payroll. Oh, payroll. Got to pay your employees. Okay, so in accounting, payroll refers to the amount paid to employees for services they provided to your company during the period, typically every 2 weeks, right? The company's payroll is important for the following reasons. It's actually important for a lot of reasons. Number one, payroll and related payroll taxes significantly affect the net income of the company. Of course it does. Number two, payroll is subject to federal and state regulations and taxes. Number three, good employee morale requires payroll to be paid timely and accurately. It's not just good morale, it's also laws. Right? So payroll. Okay, so let's talk about payroll. As you know, in your paycheck that you receive from your employer, there are these things taken out. We call those taxes. You have taxes, you have insurance, and you have any other deductions, right? 401k, whatever. Your employer is required by law to take and withhold the taxes from your check. And on your behalf, the employer then pays the respective regulators those taxes. Don't worry, we'll break it down. Well, so let's break down the check, right? Salary. Salary refers to the payment for managerial and administrative services. Salary is normally expressed in terms of a month or a year. Your annual salary, your monthly salary. It's usually a year, right? Wages, these are just the terms, right? Salary is like for salaried employees. Wages is for hourly employees. Refers to the payment of employee for manual labor. The rate of wages is normally stated as an hourly or weekly basis. Salary or wage of an employee may be increased with bonuses, commissions, profit sharing, or cost of living adjustments, also known as COLA. Those are nice to get. Just saying. Companies engaged in interstate commerce must follow the Fair Labor Standards Act. Interstate commerce is basically any business interaction in the United States. If you have employees, you are required to pay your employees by the hour. And if they work over 40 hours, you're required to pay them time and a half for their overtime. It's a nice law. I like it. Let's look at an example. We have this salesperson who's employed at this company. Wow, so the sales guy makes $34 an hour. Holy smokes. And any hours worked in excess of 40 hours per week is paid at time and a half, because that's the law, right? Our employee works 40 hours for the week ending December 27th. Getting near the end of the year. His earnings for the week are computed as the following. I'm sorry. He worked 42 hours at the end of the week. 42 hours. So, if our employee worked 42 hours, the first 40 hours are at his normal rate, $34 an hour. So, earnings at regular rate, 40 hours times $34 per hour is $1,360. Then he's got a little overtime here. He worked 2 hours overtime. Remember, anything over 40 accrues at time and a half. So we have $34 per hour times 1.5. Times 1.5, which is also time and a half, right? One and 1/2. So $34 times 1 1/2, or 1.5, times 2 hours is $102. So our employee here, John, has earned a total of $1,462 for the week for his 42 hours worked. You take your regular rate plus your overtime rate equals the total earnings for that week. Isn't that nice? That's what we call gross pay. This is gross pay. When you hear the word gross, that means before taxes or other deductions. Gross. That's gross. No, that's not gross. That's gross. That's gross means before taxes and deductions. Okay. So, again, gross pay is the total earnings of an employee for a payroll period, including any overtime pay. We call that gross pay. This thing is called net pay. Net pay is from the amount subtracted one or more deductions, right? Net pay. Net is what you actually have on your check that you actually can deposit into your bank. That's your net pay, your net pay. Net pay is the amount that is actually paid to the employee. Here are the fun deductions, right? Federal income tax, state income tax, also known as district tax, local income tax. Those are for like cities, right? That's your local income tax. Because you have your local, which is your city level, your state, which is your state level, and then the federal, U.S. level. And then, of course, in addition to all those great stuff, you have medical insurance, pension contributions, child support, you name it, right? A whole ton of possible deductions, garnishments, you name it. Yeah, the list goes on. The list goes on. So after all that fun stuff gets taken out, then you arrive at net pay. That's the amount that you actually take home. We call it take-home pay. Okay, let's talk about the taxes, because the taxes are something that is an accounting function. Employers normally withhold a portion of the employee's earnings for the payment of federal income tax and state and local and, Medicare and all that good stuff. That is the employer's responsibility, is withhold a portion. Now, in addition to that, what the slide doesn't tell you is that the employer also has to contribute the same amount of federal income tax that you paid in. Okay? So, for example, in your paycheck, if you paid $200 in federal income tax, your employer also paid $200 in federal income tax. We call that matching. The employer has to match pretty much all the taxes that go out of the business. The reason being is because the employer has to cover unemployment insurance, state and local taxes, all that good stuff, right? So each employee authorizes the amount to be withheld on their W-4. This is called the employee's withholding allowance certificate that is issued to the IRS when you are employed, right? On the W-4, employees indicate your marital status, a number of withholdings allowances. Withholdings are children, right? That's why we call them little walking tax shelters. A single employee may claim one withholding allowance. You claim yourself, in other words. Married employee may claim additional allowances for their spouse. An employee may also claim an allowance for each dependent other than the spouse, meaning children, or other people that you take care of. Each allowance reduces the federal income tax withheld from your paycheck. Federal income tax withheld depends on each employee's gross pay and W-4 allowances. Withholding tables are issued by the IRS and are used to determine the amounts to be withheld. For me personally, it's always zero. I always do zero deductions because that way they take the most out. It reduces the chances of me owing even more, right? That's just my personal thing. You can tell I'm not a big fan of taxes. Okay, let's talk about the FICA tax. This is the part I was telling you about that the employer has to pay. Employers are required by Federal Insurance Contributions Act, also known as FICA, to withhold portion of earnings for each employee. The FICA tax withheld contributes to Social Security, which pays for your retirement eventually. Some of us might not retire. Pays for your retirement. It also pays for disability insurance. And then employers also pay Medicare, which is health insurance for senior citizens. So when you become a senior citizen at the age of 65, according to Medicare, you are eligible for Medicare and Social Security. And you can collect both of those things, right? The Medicare is basically health insurance paid for you. You actually paid into it for a long time, right, without knowing it. The same with Social Security. Your employers also pay into it. The amount withheld from each employee is based on the employee's earnings paid during that calendar year. Withholding tax rates and maximum earnings are subject to tax are often revised by Congress. That damn Congress, let me tell you. Okay, so every year, every couple of years, Congress gets together, they look at the tax brackets, they make adjustments, they do all kinds of silly stuff. So like, for example, back in the 80s, we used to have 14 different tax brackets. I went from 14 to, I think like 9, then in the 90s, and then in the 2000s, it went, or a few years ago, it went from 9 to 7 or 6. They basically reformulated the tax brackets, right? Congress does that every so often. And I'm sure they'll do it again. That's guaranteed. To simplify, in this chapter, we assume there are 2 types of tax rates that are subject to being taxed. So, with Social Security, we pay about 6% on all earnings. It's pretty close. And for Medicare, it's 1.5% on all earnings. It's probably closer to 2% now. So let's look at our example, our buddy John, our fancy sales guy, right? So John, as you recall, his earnings were $1,462 for that 40 hours that he worked, or 42 hours, I'm sorry. John is subject to a 6% Social Security tax and a 1.5% Medicare tax. We do everything separate, right? So you take your 1,462 multiplied by 6%, which means John has to pay $87.72 in Social Security tax. Or actually, we do. Well, so does John. And then we have the Medicare tax, 1,462 times 1.5%. That's $21.93. So the total taxes that John's paying for that week is $109.65. Who can tell me, what is John's net pay? What's John's net pay? Good question, right? What's John's net pay based off of this example? Don't all answer at once. What do you think? What's John's net pay? Who wants to go? Lakeisha? Charles? Bertie? What's John's net pay? Looking at this example.
Is it $1,462?
That's his gross pay. So what's his net pay? I know you know this. Remember, gross pay is before taxes and other deductions. What's net pay? Charles, what's his net pay?
I'm trying to do the math real quick.
Okay. I got you. All right. So what did you come up with? Go ahead and break out your, oh, you're on your phone. Well, I was going to say break out your phone. Okay, I'll help you out. So we got 1,462 minus $109.65. John's net pay is $1,352.35. So remember, net pay is the pay after taxes and deductions. You're on the right track. The reason I asked you that is because you'll see it again I think it's on the homework or the quiz, right?
It's $1,352.35.
Yes, sir. That is correct. That's perfect. Very well done. $1,352.35. You got it. Very good. Okay, so that's taxes. Now, as you know, a lot of times there's other deductions like retirement savings, charitable contributions, life insurance, child care. Some of you might have a transportation plan at work. All kinds of stuff, right? These are other deductions. Gross earnings minus the deductions equals net pay. We call that take-home pay. So looking back at John's example. So here's John. John's gross pay was $1,462. John had to pay Social Security and Medicare. Then we realized, John also has federal income tax, retirement savings, and he's donating $5. So all of John's deductions added together are $392.60. We take his gross pay, $1,462, minus his deductions, $392.60, to get to a net pay of $1,069.40. So that's basically how, if you ever wanted to compute your paycheck before you actually got it or something like that, that's how you would do it. You go through that process. Your 40 hours times whatever your hourly wage is. If you work overtime, it's your hourly wage times time and a half, or times 1.5, times the number of hours you worked. And then that would be your gross pay. And then you could figure out your deductions based off of whatever the tax rates are. So 6% Social Security, 1.5% Medicare tax. Federal's probably, whatever. It's up there. 20, we'll call it 25%, right? And then, of course, you got retirement savings and any other deductions, right? So you can easily figure out, or at least be very close as to what your actual take-home pay would be by going through those deductions. So employers are subject to payroll taxes. We call these FICA, FUTA, and SUTA. What fun names. Okay, so FICA is, we have to match your tax contributions. So whatever you pay for federal income tax, your employer pays the same. Whatever you pay for state, your employer pays the same. Whatever you pay for Medicare and Social Security, your employer pays the same. In addition to what your employer matches, they have also what we call FUTA and SUTA. FUTA is the Federal Unemployment Compensation Tax. If you become unemployed, that's where that money comes from. Okay, it comes from both the federal and state government levels. It's monies that you paid into this, that your employers paid into the system. That's where that money comes from. It doesn't come out of thin air. It doesn't come from Congress waving their magic wand. It comes from the federal and state unemployment compensation systems that your employer has been paying into while you've been employed there. And then when you become unemployed for whatever reason, once you apply for unemployment benefits, it comes out of these two systems. So how do we record payroll? Payroll liabilities are normally recorded at the end of each payroll period, every 2 weeks. It's nice to have this automated because let me tell you, doing it every 2 weeks, if you have a lot of employees and they're all hourly, it takes a lot of time. Okay. Okay, so here's our company. Here's our payroll for ending March 21st, so after 2 weeks. After 2 weeks, we paid out $20,000 in salaries, $5,000 in office salaries, for a total of $25,000. Okay? Which means we are subject to $25,000 of that is subject to Social Security and Medicare, and we have to pay $10,000 into the state and federal unemployment tax at whatever respective rates those are at. So we have 6% Social Security, 1.5% Medicare, 5.4% state unemployment, and 0.8% federal unemployment. So here are the withholdings. Federal income tax withheld, $2,100. How do we get $2,100? We took, where is the federal rate? We took your 25,000 times whatever the federal income tax rate is for that company. And that varies. That varies based off of the annual earnings for the company. In this example, it's $2,100 for that 2 weeks. The state income tax was $550. The retirement contributions, the company contributes to your 401k, matching up to like 6% or whatever, $1,200. Charitable contributions, $250. So these are the recordings that the company makes every 2 weeks. But there's more than that, right? So we figured out what the deductions are. We figured out how much our salaries are. Now let's figure out what the tax is. So we debit our sales salary expense, $20,000. We debit our office salaries expense, $5,000, to increase our salaries expenses, right? And then we start crediting our payables. We credit Social Security tax payable, credit Medicare tax payable, employee federal income tax payable, state income tax payable, retirement contributions, charitable funds. All of these are payables, right? And then, of course, we have salaries payable. That salaries payable at the end, that's the net. That's the net. Salaries payable, that's the net. The net pay. Okay, so let's go through them. Social Security tax payable, $1,500. How we got $1,500? $25,000 in salaries, expenses for those 2 weeks, times 6% Social Security tax rate. Gets you to $1,500. Medicare tax payable, $25,000 times 1.5%, $375. Employee federal income tax, $2,100. State, $5,500. Retirement contributions, $1,200. Charity donations, $250. And salaries payable, that's the net. That's the net amount, $19,025. Now I can see you asking, Dr. B, how did you get $19,025? Well, we got to $19,025 by taking $25,000 minus this one, minus this one, this one, this one, this one, this one, all of your payables, right? To get to $19,025. And remember, the salaries payable, $19,025, that's your net payable. That's what you actually pay to your employees. So to recap, employers must match employee Social Security and Medicare taxes. In addition, the employer must also pay state and federal unemployment compensation taxes. This is why it's so expensive to hire employees, honestly. Okay. The employer has to pay, in addition, right, all of this. $1,500 to Social Security, $375 to Medicare, $540 to state unemployment, and $80 to federal unemployment, for a total payroll taxes of $2,495. How fun. Not really that fun. Okay. To record that entering, we debit payroll tax expense to increase our payroll tax expense, $2,495. We credit Social Security tax payable, Medicare tax payable, state unemployment tax payable, and federal unemployment tax payable by their respective amounts. As you know, debits always equal your credits. This is the journal entry that we make in order to increase all of our payables and to increase the recognition of our expense. And then, as you might expect, when we actually pay this, in the next 2 weeks at the end of March, we are going to debit, when we pay this at the end of March, so March 31st entry, we debit Social Security tax payable, Medicare tax, state unemployment, and federal unemployment. We debit all those, and then we credit cash to represent the payment of those payables. As you know, anything payable, payables, they go up and they go down. Those accounts go up and they go down. They go up when we record the expense. They go down when we pay it. Just like accounts payable. What about paying payroll? Oh my goodness, sometimes we got to pay them. Companies pay their employees by either electronic funds transfer, also known as direct deposit, or by issuing payroll checks, physical checks in the mail. Some people still like that. I don't. I like direct deposit. It's nice. With electronic funds transfers, also known as direct deposit, the employee's net pay is electronically deposited into their bank account each period, every 2 weeks. Or every 15 days if you're a government employee. The employees receive a payroll statement, also known as a pay stub, summarizing how the net pay was computed. How'd they figure it out? Most companies use a special payroll bank account for payroll. Yes. So, if you ever own a business, or if you own a business now, okay, and you have payroll, if you're dealing with payroll, make sure you have a separate bank account just for payroll. Just for payroll, okay? Don't use it for nothing else. The reason why that's an important thing to do is you need to make sure that there's always enough money in there to pay your employees on time, okay? Because if you don't, you get sued. It's not good, right? It's also against the law. So I strongly recommend all business owners in this class, or future business owners, or out of interest, have a separate bank account just for payroll. Very important. One of the advantages of doing this is that you can reconcile the bank statement, and it's very simple. We talked about bank reconciling a couple chapters ago. Okay, internal controls. You all know I'm big on internal controls, so this is important. You need to have internal controls. The hiring and firing process of employees should be properly authorized and approved in writing. In other words, have a contract for your employee, clearly telling them how much they're going to get paid, how many hours are expected to work. It's basically like a contract, right? It's just clear definition for the employee. It also helps you legally. All changes in pay rate should be properly authorized and approved in writing. Super important that stuff gets in writing for both you, the employee, and me, the employer. Very important that everything is done in writing. Okay? Because if I'm like, hey, Bertie, I know I'm paying you $20 an hour. We had a great year. I'm going to pay you $24 an hour. Just telling you, that's one thing. I know I want to see that in writing, right? So, it's important that all that gets in writing for legal reasons, to protect you and to protect the employer. Employees should be observed when they arrive for work and verify that they're checking in, also known as hitting the punch card or the time clock or whatever, and making sure that they check in and check out using a time card, swiping their ID badge, whatever, however you do it, right? The reason why is because you need to actually track the exact hours worked. Because otherwise, it's just theft otherwise, right? You pay your employee for the exact hours that they worked. Not more, not less, okay? It is also very helpful to do that because you need to be able to control your cost, your labor cost. And that's one way of doing it. And always a special payroll bank should be used. Let's talk about fringe benefits. These are nice. Many companies provide their employees benefits in addition to salaries and wages earned. We call these fringe benefits. Sometimes they include things like vacation pay, medical pay, retirement benefits. These are all fringe benefits. They're nice. The cost of the employee's fringe benefits is recorded as an expense by the employer at the end of every period. Vacation pay. When an employee wants to take a vacation, they accrue time over time at the end of each pay period. You might accrue like an hour or two at the end of each pay period. Most companies wait to record to adjust this at the end of the year. Not me, I adjust it every period. Makes it easier. To illustrate, we assume that employees earn one vacation day for each month worked. It's kind of stingy, in my opinion. The estimated vacation pay for the year ending was $325,000 worth of vacation pay that was accrued for the company. The adjusting entry at the end of the years for vacations is as follows. Debit vacation pay expense and credit vacation pay payable. Because it's money that the employee accrued over time. And as they use it, you need to pay it. If employees are required to take all of their vacation within 1 year, the vacation pay payable is reported as a current liability on the balance sheet. If employees are allowed to accumulate pay, the estimated vacation pay that will not be taken within the year is reported as a long-term liability. When employees take vacation, the liability for the vacation pay is decreased by debiting vacation pay payable. Salaries or wages payable and other related payable accounts for taxes and withholdings are credited. What about pensions? Pensions are nice. Most of them don't exist anymore, but some companies still offer them. A pension is a cash payment to retired employees. That's nice. Pension rights are accrued by the employee as they work based off of the employer's pension plan. For example, your employer might have a pension plan that says, if you work for me for 10 years, when you reach the age of retirement, I'll pay you a certain amount of money every month for the rest of your life or for a specified amount of time. We call that a pension. Two basic types of pension plans. There's a defined contribution plan and a defined benefit plan. Those are the two types. Defined contribution plan is a company where the company invests contributions on behalf of the employee during the employee's working years. Normally, the employee and the employer contribute to the plan. It's like matching, right? Your employer will say, hey, I'll contribute 6% of your pay every pay period, And you can also contribute up to, 4% or 6% or whatever it is. That's nice. Employees' pension depends on the total contributions and the investment returns earned on those contributions. The most popular one is called a 401k. In this plan, employees contribute a portion of their gross pay to investments, like mutual funds. That's usually what's in a 401k. 401k consists of stocks, bonds, and other investments, right? Typically, a mix of all these different types of investments together, we call that a mutual fund, which are really good, by the way. There's some that are, most are really good. There's some that aren't as great. A mutual fund, they're invested in the stock market. They earn a percentage return over time. A 401k plan offers employees two advantages. One is the employee contribution plan is deducted before tax. So we call this is a pre-tax investment into your retirement. Of course, it gets taxed when you take it out, right? And the other advantage is the contributions and related earnings are not taxed until they're withdrawn at retirement. I don't know if that's an advantage. In most cases, the employer matches some portion of the employee's contribution. The employer's cost is debited to pension expense. An example, our company contributes 10% of an employee's monthly salary to the employee's 401k plan. We assume $500,000 worth of monthly salaries. The journal entry to record the contribution is we debit $50,000 in pension expense, and we credit cash to pay the pension company. Pension company then makes the investments on the employee's behalf. How we got $50,000? That's 10% of $500,000. Now, what about the other type of plan? We call this a defined benefit plan. This is where the company pays the employee a fixed annual pension based on a formula. It's typically based on the number of years of service, how old you are, and what your past salary has been. That's the formula. Years of service, age projection, when you expect to retire, in other words. That's what they mean by age, not how old you are. It's based off of what age you'll be when you expect to be retired, right? And it's based off of past salary. Past salary because we expect that the salary will rise over time. Okay, so if you have to work there for 10 years, they look at the most recent 10 years salary history and the age that you retire at to determine how much a month you'll receive from the plan. In a defined benefit plan, the employer is obligated to pay the fund for the employee's future pension benefits. Pension cost of a defined plan is debited to pension expense, and cash is credited to pay that expense. And if there's a future problem with it, we call in other words, we can't cover the cost of that plan anymore. We then credit it to a unfunded pension liability, which hopefully that never happens. It happens once in a great while. Here's an example. Our company requires an annual pension cost of $80,000. And the cost is just for us to even offer the plan, right? This annual contribution is based on estimates of future pension liabilities. We can pay $60,000, but we can't cover the whole $80,000. So here's how the entry looks. We debit pension expense $80,000. We credit cash $60,000, and we credit unfunded pension liability $20,000. Now the idea is eventually they'll be able to cover that $20,000 at a later date, plus, the rest of it. That's the idea. If the unfunded pension liability is to be paid within 1 year, it's reported as a current liability on the balance sheet. That's actually pretty common. Any portion of unfunded pension liability that would be paid beyond 1 year is a long-term liability. That's when it gets a little risky. There are other nice benefits other than pensions that some employers might offer to their employees. Employees may earn the right to post-retirement benefits by their employer, such as dental, eye, medical, life insurance, tuition assistance, tax services, and legal services. Sometimes. The estimate of annual benefits expenses are recorded by debiting post-retirement benefits expense. If the benefits are fully funded, cash is credited for that same amount. If benefits are not fully funded, pre-retirement benefits plan liability is also credited, just like you saw in the earlier example. Financial statements should disclose the nature of the post-retirement benefits liabilities. Disclosures are included in the notes in the financial statements. You guys already know that. Okay, on to the next type of note. Installment note, which we talked a little bit about earlier. An installment note is a debt that requires the borrower to make equal periodic payments to the lender for the term of the note, like your mortgage, like your car, that is over the life of the note, like your tuition, your student loan, right? Same concept. Each note payment includes the following. Payment of the portion that is initially borrowed is called the principal. So the amount that you borrowed is called principal. And of course, there's interest. Payment of interest is on the outstanding balance. At the end of the note's term, the principal would have been considered to be repaid in full. And they'll actually send you a letter saying that you paid it in full. Keep that letter. Keep that letter for like 10 years. Okay? Just in case, you never know. Installment notes are often used to purchase specific assets such as equipment, or are often secured by the purchased asset. We call that collateral. If a borrower fails to make the note, to pay the note, the lender has the right to take possession of the pledged asset and to sell it in order to pay off the debt. Same with mortgages, right? Installment notes that are secured or purchased by purchased assets are sometimes called mortgage notes. That's what we call mortgaging. That's where the term mortgage comes from. A mortgage is where the bank covers your note, and the note is protected by the mortgage. And if you don't pay the note, which is on the mortgage, the bank can take possession of the asset, which is the house. When an installment note is issued, an entry is recorded by debiting cash and crediting notes payable. To illustrate, we have this example. This company issues the following installment to Citibank. Principal amount is $24,000. Interest rate 6%. Term of the note 5 years. Annual payments $5,698. $5,698 for the 5 years covers the principal plus the interest. Yeah. So when we first received the loan or the note, we debit cash $24,000. We credit notes payable $24,000 for the issuance of the note. And of course, we make periodic payments. Every year, we pay $5,698 for 5 years. Each installment note payment includes interest and the principal. The interest portion of the note is computed by multiplying the interest rate times the carrying amount, call it the book value, of the note at the beginning of the period. The principal portion of the payment is then computed as the difference between the total installment note and the interest component, principal minus interest. So we said earlier that we're going to pay $5,698 per year for 5 years. That means that we have an interest expense of $1,440 and the note payable, which is the principal payment, of $4,258. So we debit interest expense, we debit notes payable, we credit cash, $5,698. At the end of the second year, now you see here, you see what's happening with the interest and the interest and the note payable. Watch the amounts. We still pay $5,698 each year, but the interest and the principal balances are interest and principal amounts are different. The reason why is because the interest over the life of the loan decreases because the balance of the loan decreases. So if the original loan was for $24,000 over 5 years, as the balance decreases, that $24,000 goes down by $4,258 each year, or at least in that first year it went down by that much, then we would expect that the interest and the principal would also go down because we owe less. So in year 2, we debit interest expense $1,185, and we debit notes payable $4,513. The cash payment's still the same. Year 3, interest is only $324, and the note payable is higher, $5,347. At the end of year 5, it's paid in full, right? So that's kind of how that works. We call that amortized. We'll talk more about that, I think, in the next chapter. Some liabilities may arise from past transactions, only if certain events occur in the future. Call these potential obligations. We call them contingent liabilities. Potential obligations are called contingent liabilities. Word contingent means likelihood. Likelihood of something occurring. So contingent, it needs to be likely that it will occur, and it must be measurable. The likelihood of something occurring is, we call that probable, reasonably probable, or remote. Measurement is classified as estimatable, right? Or not estimatable. Estimable. I still can't pronounce it. Okay. We'll pretend I got it. Probable and estimatable. If a contingent liability is probable and the amount of the liability can be reasonably estimated, it's recorded and disclosed. The liability is recorded by debiting the expense and crediting the liability. This example, we have a company that sold a product for $60,000 that includes a 36-month warranty for repairs. The average cost of repairs of the warranty is 5% of the sales price. The entry for this the entry for this estimate for the warranty is the following. We debit product warranty expense $3,000, and we credit product warranty payable $3,000. Why $3,000? $3,000 is 5% of the sales price, which was $60,000. The reason why we do these types of estimates is we estimate that we're going to have 5% of our customers make a warranty claim on our sales. If the product is repaired under warranty, the repair costs are recorded by debiting product warranty payable and crediting cash. Wages payable or other appropriate accounts, whatever you used for that repair. Typically, there's some wages involved when you make a repair. So let's assume that a $200 part is replaced under warranty on August 16th. The entry would be the following to replace the defective part. We debit product warranty payable and we credit supplies. When something is probable but not estimatable, the contingent liability who occurs as probable but not estimatable is disclosed in the notes of the financial statements. If something is reasonably possible, meaning, yeah, there's a pretty good chance that could happen, we disclose it in the notes to the financial statements. If something is remote, meaning it probably won't happen, right? There's no disclosure that needs to be made if it's remote, because if it's probably not going to happen, I mean, what's the point of saying something about it, right? But sometimes they still do. Sometimes it's safe just to disclose. I always say just disclose it, Don't risk not disclosing. Always disclose when in doubt. All right, couple of ratios to know. When we talk about liabilities, we need to understand the company's ability to repay those liabilities. And in order to quickly do that, we run some ratios. The working capital ratio, current ratio, and quick ratio. These are really good measures to understand the company's ability to repay its current liabilities. And I always look at stuff like that before I make an investment in any company. So working capital, very straightforward formula, working capital. Current assets minus current liabilities. And as you know, as we've been talking about for a long time, you can find current assets on the balance sheet and you can find current liabilities on the balance sheet. Next ratio, current ratio. This is current assets divided by current liabilities. These two ratios can be used to weigh a company's ability to pay its current liabilities. In other words, I could look at these two liabilities, I could look at these two ratios to reasonably determine the company's ability to repay its current liabilities within 12 months. Because sometimes current assets, like inventory, cannot be quickly converted to cash. Other current assets, such as cash and accounts receivable. Sometimes the ratio may not be as accurate because inventory, which is technically a current asset, may not be quickly converted to cash. So therefore, the ratios might be a little not as helpful as it could be. They're still good though. Another ratio we talked about is the quick ratio. This overcomes limitation by the instant debt paying ability of the company. In other words, how quickly can the company pay its debt? Quick ratio. We do this by taking quick assets and divide it by current liabilities. A quick asset is something that I can easily convert to cash. Okay? This would include things like accounts receivable or other temporary investments. I can quickly convert it to cash. With inventory, it's difficult to quickly convert inventory to cash. I can't force customers to buy my stuff, right? So therefore, I cannot quickly convert it to cash. Here's an example. We have our company tax solutions at the end of the recent year. Current assets include cash, temporary investments, accounts receivable, inventory, and other current assets. Our liabilities include accounts payable and other current liabilities. Our working capital is, again, current assets minus current liabilities is $3,780. Current assets minus current liabilities, $3,780. Our quick ratio is current assets divided by current liabilities. That's 1.7. So 9,180 divided by 5,400, 1.7. Anything above 1 is good. Anything above 1.5 is really good. What about the quick ratio? Quick ratio is, again, quick assets divided by current liabilities. Quick assets, cash and cash equivalents. So cash, 2020. Temporary investments, 3,400 plus 1,600, which is accounts receivable. Those three things I can quickly convert to cash, right? I cannot quickly convert inventory or other current assets, but I can quickly convert cash, temporary investments, accounts receivable. The way that you know this is that look at the order of our current assets. We organize current assets based on liquidity. The word liquidity, as you remember from earlier chapters, means how quickly I can convert something into cash. So cash, temporary investments, and accounts receivable. All these things quickly convert to cash. So quick assets, cash, temporary investments, accounts receivable, divided by current assets equals 1.3. Anything above 1 is good. And we're done. Yay! How fun was that? Holy smokes, and that was quick too, right? We did that in, we did that in the right amount of time. It's almost 7. Lakeisha, always a pleasure. I know you got to go, but before you leave, are there any quick comments, questions, or concerns? If you can still hear me?
No, I don't have any.
Awesome. Well, I do.
I do. You haven't sent out anything with the Outlook yet, right? On that, not the Outlook, but the
QuickBooks?
right?
I did.
Okay, have you seen the link or how we can sign up for it?
Yep, it's in the classroom. So all you got to do is you go. Thank you for asking, by the way. So you go to the classroom. On the left side, there's a button that says QuickBooks for Students.
Okay, I didn't pay attention to it. Okay.
That's okay. Just follow the steps. Okay, I know it looks long, right? Just follow the steps. But when you get to the end and you're all registered, send me an email and I'll get you into the system. Okay.
Okay, great.
Cool.
Thank you.
You're so welcome.
All right.
All right. Bye.
Bye.
Bertie, Charles, are there any comments, questions, or concerns?
Not for the most part, but I'm sure after I look at, I'm gonna have something to, want to have a deeper meaning of.
Yeah, I hear you. Yeah, that's part of it. Bertie.
It seemed relative easily. We just wait till we do the test. This one seemed very easy.
Yeah, it's straightforward. This chapter is kind of nice. I kind of like the way that it's laid out. It's a pretty good chapter overall, in my opinion.
Yes.
Yeah, cool, awesome. Okay, and then so thank you so much. If you don't have any questions, I'd say let's call it a night.
All right. Have a good one.
Thanks, you too.
All right, have a great night, Professor.
Thanks, you too,
Right.
Charles. And Charles, if you run into anything, you just send me a quick email. Or if you want to schedule some time, we can meet.
Yeah, because I know that you're one of the very few professors that actually respond to the emails, and especially how timely you do it. But
It goes
yeah, I
right to
appreciate it.
my phone, so I just You know, I try to be as open and transparent with my students because you all are the reason why I teach, and you're the reason why I'm here, right? So I look at your time as my time, and so that's why I try to be as quick as possible. So yeah, anytime you need me, you just shoot me a note, and I'll be there for you.
Yeah, I
Thank
appreciate it.
you.
My pleasure. And I hope you
You
both
take
have
care.
a wonderful night and take care. Okay,
Bye,
Yep.
Charles.
All right. Bye bye.
All right, take care.